There is a specific moment in every long-term investor's timeline where the system quietly resets, where years of correct behavior stop producing visible results, and the account balance essentially flatlines. Most people who reach that window draw the same conclusion, that the strategy isn't working, that the math was overstated, that they miscalculated something. And so they exit, they restructure, they start over. What they don't know, what nobody told them before they made that decision, is that the flatline isn't a malfunction. It's a filter built into the compounding process itself. And the people who stayed invested just past that point didn't get lucky. They understood something structural that the ones who left. Everyone agrees on the basics. Start early, stay consistent, let your money grow automatically. Every financial educator says it. Every retirement calculator confirms it. Every compound interest chart shows the same satisfying upward curve. And most people who spend any time thinking about their finances have already accepted this as settled truth. Compounding works. Time in the market beats timing the market. The math is on your side. That part isn't wrong. But here's a question nobody seems to want to answer. If this system works so reliably, if the data is this clear, if the logic is this airtight, then why do 74% of retail investors abandon their portfolios before year 7? Not because they ran out of money, not because the market stopped working, because they stopped believing it was working for them. And that distinction is the entire problem. The median investor checks their account balance 11 times per month during years 1 through 3. By year 5, that number has dropped to twice a month. Most people assume that's a sign of discipline, that they've finally stopped obsessing. But that's not what the data shows. The frequency drops because they got disappointed, because they checked repeatedly, saw almost nothing move, and quietly concluded that either the system was broken or they were doing it wrong. So they disengaged. They went from active participants to passive observers to functional dropouts. And here's the part that should make you stop for a moment. The window they tuned out during, years 4 through 7, is statistically the most structurally important period in their entire wealth-building timeline. Not the most exciting, not the most visible, the most important. Let's make this concrete. In year 1 of a $300 monthly investment compounding at 8% annually, the interest earned on your balance is roughly $150. That's the math working on a small base. By year 7, that same behavior, the same $300, the same consistency, not a single change in strategy, generates close to $1,900 in interest in that year alone. The investor didn't change, the account didn't change, the math changed. Compounding doesn't accelerate because you did something different. It accelerates because time converted a small base into a meaningful one. And now the percentage is being applied to something worth applying it to. The perception gap, the feeling that nothing is happening, exists entirely because no one ever showed you what the slow phase is supposed to look like. So when you're inside it, it feels like failure. It isn't. It's the design. What we're examining today is the 7-5-3-1 rule, not as a motivational concept, not as a framework to make you feel better about your portfolio, as a predictive map. 4 numbers that describe exactly when each phase of compounding shifts, what those shifts feel like from the inside, and the one mechanical variable that most investors never adjust, which is also the one that separates moderate outcomes from structural wealth. Start with a number that reframes everything. 7. The reason 7 years functions as a threshold isn't arbitrary. It isn't a round number chosen for convenience. 7 years is approximately the minimum window required to capture one full market cycle: the boom, the correction, the recovery, and the early stages of the next acceleration. When you invest for 3 years and measure your results, you are measuring a fragment. You might have entered at a peak, you might have caught a correction. You have no idea whether what you're observing reflects the system or reflects timing. But when you invest for 7 years, you begin measuring a pattern. You have enough data to see how the portfolio behaves across multiple conditions, not just one. That changes the entire psychological relationship with volatility. Before year 7, every dip in your portfolio balance feels like a verdict. Your brain interprets a 10% correction as evidence that something is wrong, either with the market, with your strategy, or with your judgment. After year 7, a 10% correction becomes recognizable as a phase. You've seen it before. You know what came after. The emotional charge around volatility doesn't disappear, but it fundamentally shifts from threat to context. And here is the controlled contradiction that most investors never confront. They treat year 7 like a finish line, as if reaching it means they've made it. It's actually the starting gun. Year 7 is not the destination. It's the point at which the compounding engine has finally built enough pressure that the acceleration becomes visible. Everything before it was infrastructure. The human brain was not designed to visualize exponential growth. We are intuitive, linear thinkers. When we project forward, we add, we don't multiply, which means the first 4 years of consistent investing look almost identical to someone executing perfectly and someone executing a strategy that will never work. There's no visual feedback that separates them. The chart looks flat either way. This is why commitment to the 7-year threshold has to be structural, not motivational. You cannot rely on visible progress to keep you invested during the phase when progress isn't yet visible. Now consider the 5. Most people understand diversification as a risk management tool. Spread your capital across different assets so that if one falls, the others cushion the damage. That's true, but it's also incomplete. The deeper function of a 5-category portfolio structure isn't to protect your returns, it's to protect your behavior. Because the biggest threat to long-term compounding is never a bad asset class. It's an investor who emotionally exits at the wrong moment because their portfolio gave them no reason to stay. Think about what each category actually does from a psychological standpoint during the slow phase. A broad market index fund anchors your confidence during flat periods because you know you own a cross-section of the entire economy. It's not exciting, but it's stable in a way that prevents catastrophic doubt. Dividend-paying assets do something different. They provide tangible, measurable proof of progress even when prices aren't moving. When your account balance looks unchanged, but your dividend reinvestment is accumulating shares, you have a concrete data point that the system is still running. That matters more than most investors realize. Small and mid-cap growth positions serve a third function. They create re-engagement after recoveries. When these positions start moving after a correction, they pull your attention back in productively. International exposure breaks what you might call domestic doom loops, the tendency to assume that a slowdown in your home market means everything is broken, everywhere, permanently. And defensive assets, bonds, treasuries, capital preservation instruments exist for one primary purpose. They are the only thing standing between a rational investor and a panic sell during a 30% drawdown, not because they perform well in that environment, because they don't collapse. And when part of your portfolio is holding steady, you have leverage to hold the rest. Diversification, structured across 5 distinct categories, solves a behavioral problem that presents itself as a financial one. The investor who abandons their strategy during a correction doesn't have a portfolio problem. They have a design problem. Their portfolio gave them no psychological anchor when they needed one most knows. The 3 refers to the emotional phases that every investor moves through. Not some investors, not disciplined investors, every investor. The distinction between the ones who build wealth and the ones who don't isn't that the former don't experience these phases. It's that they recognize them while they're inside them. The first phase runs roughly from month 1 through month 18. Call it the competence illusion. Everything feels manageable in this window. Your stakes are low, so your stress is low. Small gains feel disproportionately exciting because they represent large percentage moves on a small base. The risk in this phase isn't that you'll fail, it's that you'll develop false confidence in a strategy that hasn't actually been tested yet. Markets haven't challenged you. Volatility hasn't confronted you. You don't know how you'll behave under pressure because you haven't been under pressure. The practical response to this phase is a 6-month strategy lock, a pre-committed period during which you make no structural changes to your portfolio regardless of what you read, what the market does, or how you feel. Not because flexibility is bad, because decisions made during the competence illusion are decisions made without sufficient data. The second phase runs roughly from year 2 through year 4. This is the stagnation trap. Contributions are accumulating, but returns feel invisible. The gap between your current balance and any number that feels meaningful is still enormous, and the rate of closure seems impossibly slow.
This is the phase where strategy abandonment happens, almost never labeled as abandonment, it's labeled as re-evaluation. Suddenly, you're researching individual stocks. Suddenly, a different allocation feels more appropriate. Suddenly, the steady index approach feels too passive and something more active is necessary. These are not financial insights. They are psychological symptoms of being inside phase 2. The way to navigate this phase without destroying your timeline is to change what you're measuring. Stop tracking your balance against a target number. Start tracking your share count. The number of shares you own compounds alongside the price per share. When you shift your attention to accumulation rather than valuation, the slow phase becomes legible. You can see yourself building something even when the dollar figure isn't dramatic yet. The third phase, years 4 through 7, is the volatility test. By this point, your portfolio is large enough that a correction produces a loss figure with real psychological weight. Not $100, not $500, a number that your brain registers as significant. And here is what makes this phase structurally dangerous in a way the others are not. The loss feels concrete. The recovery feels theoretical. You can see exactly what you've lost. You cannot see exactly when or whether you'll recover it, which means every rational seeming argument in favor of exiting is actually an emotional argument wearing rational clothing. The only reliable countermeasure to phase 3 is a decision made before you're inside it. Write down what you will do when the correction comes. Not if, when. Specify exactly what your response will be, because you cannot out-discipline panic in the moment it arrives. Your prefrontal cortex is not going to